The like-kind exchange, or the 1031 exchange, is the swapping of business property for like-kind business property. Things that qualify for a like-kind exchange, trading a business vehicle for another business vehicle, or a piece of equipment like a skid loader for another piece of equipment, you're trading those in and buying a replacement one. Things that don't qualify for a 1031 exchange would be like stocks, partnership interest, personal assets, your personal vehicle. You can't sell GE stock and buy Apple stock. You could sell a collector car that is held as an investment and swap it for another collector car, but it has to be a swap. You can't sell it to somebody here and buy it somewhere else. You have to be swapping vehicles. So that doesn't work very well. But anything that is not trade or business or stocks and partnership interests do not qualify as 1031 for 1031 reporting purposes. What I want to focus on, though, is the real estate side. There's a provision of the Code Section 1031 that allows you to do a deferred 1031 exchange for real estate. You get 45 days to identify replacement property, and then you have another 135 days, 180 days total from the date of closing to actually buy that replacement property. If you miss either one of those deadlines, then the 1031 exchange is void. The general rule of thumb with real estate 1031 exchange is you have to buy more property than you sold, and you have to maintain the same amount of equity, which means if you had a property that you sold for $500,000 and you had a $200,000 mortgage, you have $300,000 of equity. You have to buy at least $500,000 of replacement property and maintain $300,000 of equity. If you do that, then there's no boot and you've deferred all of the gain from that property into the next property. If you want to know more about 1031 exchanges, please feel free to give me a call at Terry Lockridge & Dunn.
Find real solutions for your tax planning at Terry Lockridge & Dunn or online at realfinancialstrategies.com.